Maybe improved. Alright, today is March 22nd, Wednesday, Fed Day, and I am an associated member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA SIPC. You should carefully consider whether trading is suitable for you in light of your own financial condition. All of my trades are placed through T3 Trading Group. Super blurry, right? Or is that just me on the VTF? There's a position disclosure. I don't know why this happens sometimes. Did I log off and on today? I might not have logged off and on today. Let me try. I'm still live on YouTube if anyone wants to post that link, but I'm going to log off and on the Do I Smell Toast? You talking about the market? You talking about PDD? There's a lot of toast out there. Let me log off and on the VTF real quick, see if that fixes the blurriness, and in the meantime feel free to hop over to the YouTube. I'll be right back super quick. And for the people on YouTube, you got my position disclosure there. The only thing that is new is TQQQ short, which I actually shorted because the market was so extended to the upside for the NASDAQ at one point today. We hit that $10 worth of extension. I really just shorted it for some mean reversion and then decided to keep a little bit just in case we continue to sell off, which I'm certainly glad in hindsight that I did, because this market ended up getting absolutely hammered on the Fed. I think it's my internet just acting slow again. It's a crazy snowstorm out. It's taking me forever to log off and log on to the VTF. One more minute, should be in there in a second, then we'll get started. Technical difficulties. Come on. I need some more RAMs. I can't get this mic to connect. Ugh. I tried to press the button too quickly. You guys can hear me in the virtual trading floor? Because it says at my end that my microphone's not connected to the virtual trading floor, which I feel like it's because I tried to log in too quickly. Oh man, tech issues are so frustrating. YouTube's loud and clear. I might just have to direct everybody over to the YouTube. Can't get the VTF to connect my mic. All right, so I'm in the VTF, but I'm only going to broadcast through YouTube. I had another crazy snowstorm going on here again. Just basically just means it's another day in the week in Idaho. If you like snow, come to me. All right, let's jump in. What a crazy day today. The SPY is down, the S&P is down 1.5% as of right now, and we bounced. We bounced 50 cents to the close. The Q's down 1.3%. also with a decent bounce since the close. A little bit of a bounce. And the Russell here down 2.6%. That's brutal. That's brutal. So much for my mean reversion theory for this week. Intraday price action chart for the SPYs I still got up. Look, was pretty much on point today. Fed days, midday price action is usually trash. That's what we discussed. In the beginning of the day, you get your normal opening, price discovery period. However, we had a flat open. So flat opens don't give me much of an advantage to begin with. So the first hour of the day actually turned out to be relatively boring because there's a flat open. And then we tried to break out here a little bit around 10:20, which was interesting, but it was never confirmed by the IWM. The IWM never confirmed the breakout. SPYs went almost to 400. Qs tried to rip a little bit at 10:20 as well. And then what happens? At 10:30, what? All right, I don't know. Sorry. I'm just gonna push. At 10:30, I got off the radio, and I think the last thing I said was probably don't trade till 2. And you can very clearly see why. This is very typical price action for 10:30 to 2. Just nothing going on. Choppy, sloppy, nothing to do. 2 o'clock hits. Fed comes out, 25 basis point increase, which is what the market expectations were, combined with what seems pretty dovish. They're saying exactly what we thought they were going to say. They are saying that the banking crisis. The stream just drop again? Man, my internet is like super slow right now. The banking crisis that's going on, this miniature banking crisis that's going on. Again, Pat, you're distracting the heck out of me with this meme, dude. I gotta scroll up. All right, sorry. Let me regather my thoughts and my process here. So we increased by 25 basis points. We coupled that with language where our dot plot, if you will, is only showing 25 more basis points of increases for 2023, then stabilization, and then actually 75 basis points of decreases in 2024. That's what it's showing at this moment. Can change. And the Fed acknowledged what we were saying, which is that this miniature banking crisis and the fact that a ton of money is coming out of regional banks and is going into the big banks means that credit will tighten. We were saying from the beginning, it's a really bad thing actually for the U.S. economy if people don't want to do their banking with any reason forward. It's those regional banks that feel comfortable lending money in their community for businesses, for mortgages, in a way because they know their community, so they're able to do it in a way that these really big banks, your Bank of America, might not feel comfortable doing. So that leads to credit tightening. The Fed acknowledged that, so that this tightening may amount to increases in interest rates, basically. Like the same thing that they're trying to accomplish in terms of slowing down the economy, creating this soft landing in order to be able to bring down inflation. A pullback on credit issuance from banks because of what just happened helps to accomplish things for the Fed. Therefore, we don't have to increase at the same rate that we thought we might have to continue to increase. My thought process coming into this was that was probably the most bullish thing that they could do. 50 basis point increase, I think, would have killed the market today. They didn't hike at all, which was kind of where the other probability was at this point. It shows that they are very concerned by this banking crisis, and it also shows that they don't have tools to combat inflation anymore. They want to be able to show confidence with this 25 basis point increase. We still feel the economy is strong. We don't think this banking crisis is too big of a deal. We think it's specifically focused on these couple of banks that have blown up, but everything else is stable and fine. So we're going to come in with this 25 basis point increase and show that we still have the ability to combat inflation with these tools if we need to. We feel comfortable doing that, but we don't need to continue to do it going forward because credit's going to tighten. So I personally thought that that was the most bullish situation that we could come up with. Yet, at the end of the day, we still had a very big sell-off. So I can't help but wonder, if there was any circumstance, no matter what the Fed did or said today, that actually could have brought us higher. I don't think there was. And you can see the initial reaction before the press conference at 2 o'clock was to the upside. And the biggest thing that I was thinking was, on the surface of this news, I actually think we should be trading higher. But the market really struggled to be able to go. First bar is fine. Second bar doesn't give any follow-through, right? It turns out to be a doji. We pull back to our equilibrium area. SPYs and Qs held the initial low. That's always the first spot that we're paying attention to. So in this case, that is 398, spot 43. SPYs held that. Qs held that. Again, it wasn't confirmed by the other indices. The Russell was relatively weak again. And then we kind of ranged out here. Maybe the market's waiting for the press conference to begin, but like Pat was saying, 40-50 or so seemed like upside confirmation for an intraday breakout. 398.50 seemed like confirmation for a breakdown for the market. We had a false break higher at 2:30, right as the press conference was starting. That led to a false break lower at 2:35 when the press conference was still more or less getting underway. Again, these fake moves are very common on these Fed days. Sometimes you don't get a fake move at all. If there's a real surprise, you get an immediate trend that begins. That's relatively rarer. Sometimes you can get as many as 3 or 4 false moves. So today we had a false move up, a false move down. Then we had what seemed like the real move to the upside as Powell was beginning to speak. And he was just confirming everything that I just stated earlier. I feel like is the most bullish situation. And then the market just totally fell apart. And I can't point to, and I'll obviously do some research after the market closes and after our meeting today. I can't point to a single thing that was specifically said that hit the market down. The only thing that seemed negative to me, and I really can't remember what time this was where this actually occurred, the only thing that really seemed negative to me was when Janet Yellen actually came out and said that there is going to be no increase in the FDIC insurance, when Jerome Powell, one of the first things he actually said was all bank deposits are safe. It sounded like Powell was guaranteeing bank deposits everywhere, like it's almost unlimited FDIC insurance, which I do think actually is not necessarily a good thing because it can lead to banks potentially taking risks. It's a moral hazard situation. But that's what Powell seemed to say in the beginning. Then Janet Yellen said the complete opposite. Who do I believe? I have no idea. But markets work in feedback cycles. So, we break down, we get back to our neutral area, we actually tick above it, and then we created a pivot high here that just led to a ruthless sell-off into the close. A really ruthless sell-off into the close. It was absolutely brutal. And if we go back to our daily chart, SPYs are right back to the range in which they were a couple days ago, that inside candle that we just had. SPYs are just below the 80 EMA on the daily chart. The SPY is not broken here. Today's candle is certainly damning. This is not a good candle. We were finally clearing above that key $400 area that I've been talking about, negating the negative Maribozu from the 9th, which is really the beginning of our banking crisis. We were set to negate that today at one point at highs, and things were looking actually really good, albeit starting to get a little bit too extended. From an extension perspective, and this is how crazy today's range is, the SPYs were like $8 to $9 extended at highs, and then closed actually, and that's from the 80 EMA, and then closed below. It's always a little bit tricky when you're measuring extension from an 80 EMA when the 80 EMA is below the 21 EMA. It might be actually better in that case to look at the 21, in which case we're more like $7 extended, which is still a decent amount. That's $6-7 of extension. I was talking about this with the Qs this morning and during the day. That's just the area where I feel like I don't have as good of a risk-reward probability of success on either the short side or the long side. It's like we're too extended to buy, we're not extended enough to short. So you could make an argument maybe that highs, that's where we were, and we never really got that overwhelming upside extension where you really want to come in and kind of put the short on. But then obviously we got wrecked back down. This just brings us right back to where we were. And if you kind of, you know, one of the games I love playing, we've been doing this for well over a year, is the, you know, bullish, bearish, neutral game. And then we try to do that with every index, and we try to do that on multiple time frames, like a short time frame, an intermediate time frame, and a long time frame. You will have the most success when you've got confirmation across the board. My small, intermediate, and large time frame is bullish in the SPY, bullish in the Qs, and bullish in the IWM. That doesn't happen too often, or the complete opposite, bearish. So that's one of the things that you want to try to assess with the market. And we've hit a point here where I would argue that we are, at least with the SPY, and we can look at the Qs and the IWM to see, for confirmation. After today's candle, we are, I would say, short time frame, neutral to bearish. Neutral because of kind of, we're just back where we were 2 days ago. Bearish because today's candle, I mentioned, is very damning. It's kind of like a breakout failure for the SPYs. The intermediate time frame, I think, is very much neutral. You can see here, we are midpoint of a range that we have more or less been in since last April, which is kind of crazy. And then big picture, I would still want to make the argument that we're actually a little bit more on the bullish side of neutral. Small picture, I would say bearish side of neutral. Very big picture, bullish side of neutral. Because we are yet to violate, you get this low, high, higher low, higher high. This could still be another higher low from March 13th. But you need the market to actually break up, and it's not. So you're starting to kind of smaller time frame here, wedge out a little bit again. You really need this market to get above 400 bucks and break eventually this pivot high for the big picture higher high and higher low to come into play. So, you know, bottom line, when I'm looking at a neutral market, which is really what this is, you know, small time frame is bearish to neutral, intermediate time frame, and big time frame is bullish neutral. It makes it tricky, but it also makes it a two-way market. There's opportunity to make money long. There's opportunity to make money short. It's about understanding extension, understanding relative strength, and understanding relative weakness, and understanding the story kind of as it evolves over time. So that's what the SPYs. Do we have a different picture for the Qs? Why am I not getting today's candle? There it is. Do we have a different picture for the Qs? The Qs with this incredible relative strength since the banking crisis, which we correctly called when we said on that Monday that Apple can be a flight to safety here because of the cash on the balance sheet. Qs, I would say, are more bullish. You know, like the Qs got to $10 extended today. You know, we got to 315. The high of the day is 315 quarter. The ADMA as of the close is 303.74. We got $11.50 of extension today in the Qs, which is why I started shorting the TQQQ. I was even saying, and I don't want to get off topic, but I was saying, you know, if we get that $10 of extension, I was saying when TQQQ was trading at like 26.40, 26 quarter, I said I'm putting offers out in the $27 area because that should coincide with about $10 of extension. That's when I want to begin to short. I was able to keep that for the rest of the day. But if you look at the Qs, and if you look at some of the names in the Qs, like if you look at Apple, which we'll take a look at in a second, this just looks like a technical pullback of a strong chart where it got a little bit ahead of itself. You could certainly make the argument that this candle here is too big too fast. There's a big tail here. There's an increase in volume. But we still didn't even get down to the ADMA. So the Qs here on the small time frame, I would say is bullish, but today's candle puts it in the penalty box a little bit. The intermediate time frame, you pretty much got higher highs and higher lows still kind of going on in here. Maybe you could make the argument that the intermediate time frame is like a little bit more neutral to bullish. Because we are still somewhat in a range here that we've also been in since April, May. And then the big time frame, you very clearly have this chart. I remind myself of a concept that we had spoken about, I think it was in yesterday's afternoon meeting when someone was asking me a question about double tops and double bottoms. we should have, air quotes, should have gotten a new high today. Maybe we couldn't because it was so extended, but for the moment, because this is an equal high, it makes it a challenged trend. So you have a challenged uptrend. But the cues here, I would argue, are pretty much still bullish in every time frame, with the exception of the fact that today's candle puts it a little bit in the penalty box. So that's non-confirming on our SPYs, which we're saying are more or less neutral. Now you go over to the IWM, and you get the complete opposite picture of the cues. The Russell looks like trash. It's certainly bearish. You broke down really hard. You're creating a bearish consolidation in front of support. Intermediate time frame, I would say, is neutral bearish. You know, it's still in this range also that it's been in since May, but it's kind of making a bearish consolidation and kind of testing support of it. And then the big time frame is, I would say, is also kind of neutral at this point, because you got your high neutral, but if we lose 170, it becomes bearish. So again, this exercise I think is really important because it gives you an idea of probability of positioning. And the most difficult thing about it is I'm just getting totally mixed signals. The SPY is telling me one thing. Gosh dang it, man, I feel like I keep losing the YouTube. I hope you guys are able to hear me. Crazy snowstorm out. I wish I could turn this camera around and you'd be able to see it. Anyway, you know, so when I'm trying to think about positioning here and how I want to focus in this market, long, short, you know, or running more of a mixed portfolio, I just got very mixed messages. SPYs are neutral. Let's just call it Qs bullish neutral. And we'll call the IWM bearish neutral, on the verge of becoming, you know, more full-out bearish. It's really hard to have conviction. And that's why I'm saying for tomorrow, so the day after a Fed day is oftentimes a trend day, I could still very much see us trending in either direction. I know that today's candle is damning, but I have seen in the past Fed days, initial reaction from day one, which in this case, let's say, is down, and then the next day when you get that opposite direction. We saw that last year, the opposite, where we had a couple Fed days where the initial reaction, the Fed day was great, we closed well, and then the trend day that followed it entirely negated the move. So when I'm looking at the market, I'm trying to figure out, all right, tomorrow, will we have a trend day? Of course, the answer is maybe. There's a higher probability than normal that we have a trend day tomorrow because it's the day after a Fed day. Which way can that trend day be? I would say flip a coin that's slightly tilted towards down because of today's candle. But I still really think it's flip a coin because our big picture we just kind of discussed. And, you know, like I said, when it comes to the day after the Fed, you sometimes can get a move that's entirely in the opposite direction. It really wouldn't be that unusual. And I still can't go back to, I still am going back to thinking that what Powell actually did and said today was the most bullish scenario that he could have done. I can't help but look at this market, which obviously sold off today, and ask myself, well, what possibly could he have done or said differently that would have made us go higher? And I don't have the answer to that because I don't think anything could have made us go higher. If 25 basis points, but then announcing a lower neutral can't bring us down, can't bring us up, then I really don't know what could have today. It certainly wouldn't have been 50 basis points, and I really don't think it would have been the no-hike situation. Though the no-hike situation, like I said in the morning meeting, is also a situation where I could really have seen the market going either direction on it. I think that's all I've got today from the big picture stuff. From a small picture stuff, you know, I went over my QQQ trade again and exactly kind of what I was doing there. I've still got some TQQQ into the close. I traded some Affirm today, which ended up basically being a break-even trade. I can't get my charts to load. My internet is atrocious. I don't even know if you guys can hear me or if I'm talking to nobody. But yeah, I tried this Affirm because it was getting a ton of bull flow into this bull flag area. I was able to kind of kick a little bit of stock into this move in the upper 90s, and then I traded it in such a way where I kind of traded out of the position and ended up being neutral. So that was that position for me. Oh, I did trade it at UPRO. Can mention that also. Just on this test of this low, we pulled in very deep, concerningly deep. but held that low. So just went long versus that low. Was able to get kicks. So that also turned out to be a break-even trade. I traded GameStop, which turned out to be a very small winner for me. On the break of this 24, I took it as a pure scalp. So I actually got shaken out of the position when it ticked back below 23.90, which you can't even really see in the chart. It was on this 10-10 candle when it went up to 24 quarter. It actually ticked back down, stopped me out, and then went. That's the problem with pure scalp trading, and I don't really trade like that anymore. For this exact reason, you end up missing moves. And that was it for me from a new trading perspective. Continued to manage my positions. You know, did decently with Apple and Amazon and Google today, despite the fact that they then sold off pretty hard. So that's all I got. I am happy to answer any questions that you guys have. First thing I'm seeing here, Eddie, when you mentioned shorting TQQs at the 27 level, you shared, I'm not going in heavy all at once. I know you get in different levels that is working in your favor, but would you mind explaining how you do that? Thank you. Sure, I'm happy to do that. So I can tell you exactly what the strategy is that I've been implementing from a hedging perspective on extension. And it goes back to something that I've mentioned earlier about how I hedge, if you even want to call it a hedge. I've mentioned in a recent meeting that, some years back when I was concerned about the market for whatever reason and I had a bunch of longs on, I would just outright short some SPYs, short some Qs, and then ignore the position because now I'm hedged. If the market goes down, I've got short exposure, and I didn't have any stop loss for it. I didn't have a specific game plan for managing risk or even managing reward. It was just, I am uncomfortable with the market. Let me short some SPYs. Let me short some Qs. The statistics on that are those hedges very consistently cost me money, which you can make the argument that that's what you're trying to do with a hedge. It's not the end of the world if your hedge costs you money because your positions are actually working out. But that's not how I'm trying to trade. I trade for directional movement. I trade for alpha, if you want to use that term, which I think that term gets overused. So I don't want to just have a performance dragging hedge on. So how my approach to hedging has evolved now is I've got very specific rules for how I'm doing it, and I consider it to be more of a trade than an action. So a truism of the market is that when the market gets away, this could be any stock, any market, any time frame, when the market gets away from its 8 and 21 EMA, it gets away from that equilibrium area. What is happening when the market gets away from it? The market's getting extended. If you are 2 pennies above the 8 EMA on the daily chart, you are extended. But you are extended by a very, very, very little bit. And then the more you can become, there's degrees of extension, right? And a market that is extended can always become more extended. So maybe right now you're 2 pennies above the 8 EMA, you're 2 cents extended, that's nothing, you're not concerned about it at all. We would just consider the market to be at equilibrium. And then the market continues, now you're $2 away. Let's just say it's the SPYs and the Qs. Now you're $2 away from the market. It's like, okay, $2, we understand is still kind of nothing. You can still get further continuation. We start to get to that $6, $7 amount of extension from the 8 EMA on the SPYs and Qs. How is this happening? How am I going from 2 cents extended to $2 extended to $7 extended? Is momentum. The thing that creates extension in a marketplace is momentum. It doesn't have to be a massive amount of momentum, though it can be. A massive amount of momentum would give us that $10 to $15 of extension. But technically, even if you're 2 cents extended, you had enough momentum in the market, meaning that there was enough buying high, right? What's the definition of momentum? The greater the price, the greater the demand. That's the definition of momentum. So if you were able to get 2 cents extended above the 8 EMA, which again, I'm just using an extreme example on the downside, you had to have 2 cents worth of momentum. You had to have 2 cents worth of market participants that were willing to buy higher prices, right? That demand actually increased as the market went up, or otherwise you never would have been able to get 2 cents extended above the ADMA. And that phenomenon can continue. So the market keeps going up, you go from 2 cents extended to $2 extended. The greater the price, the greater the demand. You get to $7 extended. You get to $10 extended. And we've kind of created these levels in our mind now, just because this is how the market's been trading for over a year, and knowing your market environment is really important, where your 2 cents extended, we don't care, you're at equilibrium. Your $2 extended, we still don't really care because it's not extended enough. The market can very easily continue. You get to $6, $7 extended with the SPYs and the Qs. That's when we hit that point where we say it's a bad risk reward to be long, it's a bad risk reward to be short. Because we could still go another $3, $4 of momentum extension to get to 10, 11 bucks of extension, but you're also $6, $7 extended, and the market could easily correct. And again, it is a truism that eventually all markets will have to touch that ADMA at some point in the future. There's a number of ways in which they can do that. They can go back down to it, that's called a price correction, or they can go sideways, that's called a time correction, where eventually the moving averages catch up to it. It's similar to what we were looking for on the 5-minute chart with the gap up yesterday. Right? This gap up makes extension. This is a time correction. The EDMA catches up. That's when you look for continuation, which didn't happen yesterday, but that's when you look for continuation. So it's a truism that you're going to go sideways, you're going to go down, or eventually this moving average is going to catch up. Or even if you have momentum where your extended market becomes more extended, somewhere along the way, the momentum runs dry, and you go sideways. So going back to what I was just saying about the daily chart, you know, $2 extended, not a big deal. 6, 7, we have a bad risk reward. 10 plus, you don't, if it's to the upside, let's just say, you don't want to be doing any more buying, and you possibly want to be looking for shorting signals. So that's the initial starting concept that I have to get across, Eddie, in order to answer your question. Now, the next thing I'm asking myself when I'm $10 extended in the market, when I'm seeing a market that's $10 extended, is how am I positioned right now? Am I 100% long or net long as the market's $10 extended, as it's $12 extended? If I am, I should be concerned. I should expect to be giving profit back on those long positions. Maybe best case scenario, we start going sideways for a few days. Moving averages catch up, and then we get continuation. That'd be best case scenario for my longs. Worst case scenario is we have a price correction back down for my longs at least. Well, I guess worst case scenario is we have a complete reversal, but I don't predict reversals. What I am going to predict, and it's been very consistently accurate, is every time I get to $10 plus, I'm getting close to the point where the momentum's not going to be able to continue, and I'm going to have to get either that time or price correction. So I will lighten up on my longs in this instance, and that's what I was doing today at highs in the Qs. I was selling Apple, I was selling Amazon, I was selling Google. I'm lightening up on those longs. The idea with that is to go back to the cash flow idea of trading that I like to do, where I trade around these core positions, is I'm going to book this profit. My positions are super extended. I know that the ADMA is going to touch the marketplace again for these names. I'll buy the stock back on the pullback and keep the P&L difference. At the same time, now that we're $10 plus extended, and there's a very high probability of a price correction, what if I begin to build into a short? Because that will also cushion the P&L give back that will inherently happen on a price correction. And even if there's a time correction, the market goes sideways, that's fine. I still won't be losing money on the short. And if there is still further momentum where the market's able to go from $10 extended to, let's be really extreme, we get all the way to $15 of extension, I will have a game plan in place where I will actually slowly build into and get even heavier on that short, because I understand the way probability works in the marketplace, that at $10 extension, I got a pretty high probability of a price and time correction beginning soon. At a $15 extension, I have an extremely high probability of a time and price correction beginning soon. And at the same time, and this is where the hedge dynamic of it kind of comes in that enables me to be able to do this, my longs are going to continue to pay me. So yeah, I hate the idea of being hedged, and that hedge being what I used to do a long time ago, where I'm just donating money to the market because the market's going up and I don't have a plan in place. But if I trade it in this certain way that I'm kind of describing, I can get heavier and heavier in that short because I understand that eventually the market will touch the ADMA. And then the game plan I have in place to get out of the hedge, to get out of the short trade, the reward game plan of it is actually specifically based on where the ADMA is in the daily. All I'm really looking for when I get that $10 is for the market to touch the ADMA on the daily, and I don't really care how it happens. The game plan is in place where as the moving average gets closer to where price currently is, I'm sizing down. As the price action is getting further and further away from the moving average because it's getting more and more extended, we're getting $10 to $15 of extension, that path, that trajectory is taking place, I'm getting heavier. So the degree of size depends on the degree of extension. And then when I'm taking the position off, I will take the position off in the same way for a time correction as I will for a price correction. If we price correct down, well then I'm gonna be bidding out on the way down and putting the cash in my pocket, and that's it. If we time correct and we go sideways, I'll actually be bidding out of TQQQ, which is what I've been using to hedge. This is my main product I've been going to recently. I'll actually be getting out at more break-even-ish prices of my entry. But that's not I'm not trading my price in the Qs, I'm trading the degree of extension, if that makes sense. Because as we become less extended, there's a higher probability of upside continuation coming in, and therefore I don't want to be as heavy in the position. So what I did was, again, to kind of go back to, so I looked at the market off the first high. So first of all, I already know where the daily chart ADMA is. Let's call it at 304, all right? First uptick here goes to 314.40, and I wasn't paying attention. And that's why I'm so glad I have this team. Because Pat asked me, hey Derrick, where do you think that you're going to start looking for shorts? And I know that Pat's question actually was for like the momentum trade on the downside and the break of support, because that's what he was looking at. I'm pretty sure that's what Pat was looking for. But then I said to myself, I was like, oh, wait a minute. We just upticked to 314.50. That's about $10 worth of extension. But also it's a Fed day, so we could easily overshoot that with some momentum that comes in. So I looked at where we were at 314.50. I looked at where the ADMA was, and I basically was like, all right, I want to really begin to short TQQQ at QQQ 315 equivalent, which I think is going to end up being about $27. And at that spot, we're $10 to $11 worth of extension. But I am going to recognize that especially on a Fed day, we could get to $15 of extension if we want to, especially because of this wacky lack of confirmation for a lot more room to potentially bounce, and that whole kind of conundrum that we've been dealing with for like a couple weeks here, which is so unusual. So my game plan is in place where I just started layering out offers, starting at 26.96. 26.96 was my first offer. We actually, when we got to 26.93, I didn't think I was going to get filled, so I decided to downtick some. I downticked some 26.92s, and then the high ended up being 26.96, so I got filled at 26.96. Now what I'm doing here is I'm starting with a little bit of a larger core size. Not a huge position. Not a position that's so big where if TQQQ rips because of momentum to $28, that I'm in a whole world of trouble. Especially because I've got the longs on. But I'm starting with enough. I need to have enough of a core position. I can't just have 100 shares, right? Because if I got 100 shares and the market begins to drop, I can't do anything with it. I gotta have enough of a core position where I can piece out of stock, you know, more or less on the way down. But I also have to be nimble enough still and light enough still where if the market were to rip another dollar and we were to approach $15 of extension in QQQ, I don't want to be beginning a hedge in the Qs because we're $10 extended and then liquidating my hedge as a stop loss because now we're $15 extended. It doesn't make any sense. It's completely counter to the entire game plan that I have created that I'm kind of discussing with you. So I need to be prepared. This is a trade, but it's not a trade with a stop loss. The reason why it's not a trade with a stop loss is because I can afford to do this because of the longs that I have on. But I still don't consider it to be the type of hedge like what I was describing earlier that I used to do, where I just blindly short some SPYs, blindly short some Qs, and okay, if the market pulls in, well, at least I got the short on. That helps it. The higher degree of extension, the more we go from 10 to 15, the more I actually want to get heavier, short the Qs, and lighter long my long positions, because the probability of a time and price price correction goes from pretty high at $10 of extension to like extremely high at $15 extension. So not only do I not want to get stopped out of this TQQQ if it gets above, like, I don't know, 27, I want to just keep getting heavier and heavier and heavier as I lighten up in my longs, which will make my long-short portfolio, if you want to call it that, become more market neutral as we get to larger degrees of extension, and then more net long as we get to lesser degrees of extension via a time or price correction actually occurring. So that is like very specifically what I'm looking to do. And I'm really just looking for that pullback. You know, I'm really just looking for that pullback in the Qs at that degree of extension. You know, sometimes when I take that trade, I will just have a target of the 80 EMA on the daily, where the second we touch the 80 EMA on the daily, no matter what, I will be 100% out of the position. Sometimes I'll keep a little, sometimes I won't even be that aggressive. Sometimes I just want to pull back of a percentage of the extension. It's kind of what happened today. Sometimes I will, if we get to the touch of the 80 EMA, I'll keep a runner for the bigger move in case I think that there's the potential of a bigger sell-off, which is actually what I ended up doing today. You know, you can just see my TQQQ executions here, right? This red's my down tick. Actually, no, this red's my down tick. This red is my 96 cents. I accidentally shorted slightly too many, so I covered a piece right away, just based on my game plan. I got filled on the bid down here. This is actually a reshort on the balance. I got filled on the bid. I got filled on the bid. And at this point, all I was really looking for was a move to 26.50 for the Qs, for this TQQQ as a hedge. Because again, really all I wanted was to negate a percentage of the extension, not even the full extension with this trade. Sometimes I'm more aggressive and I'm looking for the full extension. And I said, you know what, I'm going to cancel that bid because that's where I would have liquidated. I'm going to instead keep a runner that I'm just going to hold entirely because it is a Fed day in case we lose that opening low and they really sell us off. So that's why you see no more covers after I covered some at 26.66. I said, I'm not covering anymore at all. I'm just going to hold this and see what happens and let it run. And if we closed, when I saw that Josh got fully out of his position here, which was a great cover. Josh was short, fantastic cover on this bar. Huge downside move. Doji comes in, he covers the position. I really thought about liquidating my position there as well. I said, you know what, I'm just going to keep this runner on no matter what. And then depending on how we close, I'll just close it out into the close. So this bounce comes in. If we closed in this 26.20 area, I would have closed my TQQQ position entirely. Because we then just got destroyed, which also means now I'm giving back P&L and adding back to the long positions that I have on. Because we just got destroyed, I was like, I'm just going to actually keep this TQQQ overnight at this point, just in case we have a nasty gap down or something like that, which we could have. So, long answer to your question, but that is precisely what I'm doing, and it has worked extremely well for me for the last year and a half with those bear market rallies. Every time we've had these bear market rallies, like in 2022, which for the most part I would do really well on the long side, I shorted this top in March. I didn't capture this entire down move, but I captured a piece of it. I shorted this top in August. It was the exact same thing. Did not capture the entire down move. Caught a decent piece of it. And then, you know, there's been other times here where, you know, it hasn't led to as big of a sell-off, but I'm still, you know, maybe shorting every time you see SPYs and Qs $10 extended, I've been shorting. So here, you know, I was shorting into this move like a few days. I shorted, and this was the one where I actually was a little too early. I was worried about, but I was just shorting again a few days ago. It was pretty much the exact same game plan. I got out of it entirely by the next day. Yeah, man, these internet issues are brutal. Sorry to hear that. It is dumping snow out. I do not use stops on that. That's correct, Greg. But it's really important to know that I couldn't do this if I didn't have the longs on. I can't just be, you know, short the Qs like I am because we're $10 extended with no stop loss, getting heavier and heavier and heavier, basically averaging down to potentially $15+ of extension in a crazy upside event without having a stop loss out and without knowing. I don't know exactly what my dollar risk is going to be on that. So I really can't do that without having the longs on. If I was 100% flat, I would have to have a different game plan. Really sorry about these internet issues. I'll be back in New York eventually. Cool. Over on YouTube from Hemming, I have a question on how to take profit again. I shorted the Qs at 1450. Okay. At 1450 versus the 1445 high, so basically versus the high of the day. That's fantastic. I got the risk covered quickly, but I'm not sure how to do it next. It dropped fast and deep. So I covered 10% every $1 drop. What is the best way to do it instead of what I did? Sure, so it's a really good question. So the first thing you need to be asking yourself is, sorry Anthony, I'll take a look at that in a second. I'll scroll back up, I missed it. The first thing that you want to be asking yourself when you're creating a game plan for reward is, what type of trade am I in? Am I in a with trend trade, or I'm in a counter trend trade? Because the answer to that question should create differences on what you're going to do for profit taking. If it's a with trend trade, I want to be greedier. I want to sell less incrementally, what you're describing, covering 10% every $1. That's incremental covering of your short position. That's fine. If I'm with the trend, I will still do that, but I will do less of it and trail more. So I'm holding a larger percentage of my position to try to be able to catch a bigger move. If I'm taking a counter trend trade, which is what this is, you have to remember that most counter trend trades fail. Most counter trend trades fail. So most likely, even though this turned out to be the high of the day, the probability is that this will not actually day at this point. We're trending higher, we're breaking higher. The probability is you can get a higher low and a higher high. That's the higher probability. So since there's a higher probability that you're just going to get stopped out of that position, greedy. So I like the idea in this case of what you did, of covering some incrementally. I also pretty much always am using that equilibrium area as a target. The 80 EMA is target number 1 on a counter trend trade. The 21 EMA is target number 2 on a counter trend trade. So maybe you cover some at 1-to-1 to be able to cover the risk. Now you're left with a core position. Of that core position, you sell, you know, 25-30% at the 80 EMA, 25-30% at the 21 EMA, and then you hold, you know, the rest just in case of a reversal. Or you could even be more aggressive in profit taking even than that. You could cover another 50% of your core position. This is after your 1-to-1 at the 80 EMA, and another 25% of your core position at the 21 EMA, and then hold 25% of your core position, which, if my math is correct, is 1/8 of your original position for the actual bigger reversal should it occur, because it's much lower probability. So that's what I do. I missed a question from Anthony in the VTF, so let me scroll up for that. As the market was approaching highs, I was looking at a potential AMD short. It scares me a little bit because AMD is the strongest stock in the market. Man, I'm so delayed on my internet today. It's kind of wild. This is the worst I've seen it. This is the worst I've seen it since I've been out here. But it's, again, it's just dumping snow out. So anyway, you are, as the market was approaching highs, you're looking at AMD, so we're going to just assume that that's highs here, which is like 220. Yeah, 220. It was about $9 extended from the daily, having just broken 101. Okay. Okay. I let the 240 candle. What the hell is going on, man, with these charts? It's just a mess. All right. I let the 240 candle. It's this one. Clear, and then hit on the 245 candle right before 247 at 101.16 for 200 shares. I immediately got the sense I was too early as AMD continued ripping up. I did not put a stop in, but had a dollar limit in my head. I would have stopped myself. That's very dangerous. I would have stopped myself out. So that's called a mental stop. Mental stops are very dangerous. I don't recommend them. It's a slippery slope to not getting out when that happens. It's very hard when you're seeing a stock trade through your stop loss to have the discipline to be able to trade through it. I knew I was early, but also believed strongly enough I was right, waiting patiently for it to top off. Sure enough, it came down, and I eventually put a trailing stop in about $1 below my entry and made a decent profit. In hindsight, I wish I had only trimmed 100 shares and trailed the other 100 shares to maximize profit. What are your thoughts on my entry and waiting it out, as well as reward maximization after thought of keeping 100 to trail for additional profit? Sure. So a couple things about it. First thing that I should really make crystal clear: those numbers that I'm talking about with the spies and Qs of $10 plus extension, $15 plus extension, that does not apply to every individual stock. Every stock is going to be unique based on the beta of that stock. And really, I always look at the spies and Qs because it's easier in terms of dollars of extension from the ADMA. Really, the correct way to do it, even though I don't do this, the correct way to do it would be to be looking at all stocks in terms of percentage extension. The reason I don't do it is because my mental percentage math is just not good enough, to be totally honest with you guys, which is my own problem. I should figure that out. I'm not quick enough without like a calculator, and the way I trade so fast that I'm not taking a calculator out. I'm just not quick enough with mental percentage math to be able to look at a stock and go, this one is 9.5% extended, and this is what this means. And then you also have to keep in mind that every stock is going to be different. If you're looking at Campbell Soup or Procter & Gamble, 5% extension in Campbell Soup or Procter & Gamble is very different than 5% extension in AMD or in, I don't know, a crypto stock or an AI stock or, whatever that hot, short squeeze stock of the day is. So obviously $9 of extension in a $100 stock is a lot, but you definitely want to understand this type of stock that you're trading, because I don't think that AMD at 101 with the ADMA at 93.50 with 3 rest days in a row is actually so extended that it can't get to 104 or even 107. So again, it comes down to knowing the stock and knowing the name. The SPYs and Qs and the IWM, we look at it constantly every single day. So I'm just so confident in those extension amounts with those names. I don't have the same degree of confidence necessarily with every individual stock. One thing that you can do, and I did this with Amazon and Google recently, is you can just scroll back over the course of the last year or so and look at all of the times in which it had the biggest moves maybe like this one here, back in July. I'm just seeing this one randomly and trying to figure out what the extension was at this point. This is when it was a $70 stock, a $75 stock, as opposed to it being a $100 stock now, so it's already going to have percentages differences. But this low is 71.60 with the ADMA at 77. So here you were able to get, sorry, the ADMA is at 79. Here you were able to get $7 worth of extension when it was a $70 stock. So 10%, that's $10 of extension basically now. It's similar to where it is here. It is similar to where it is here. But again, that's just looking at one case. I don't know, real quickly eyeballing what happened here in November. This also looks like an extreme one. It got up to 79, and the ADMA was at 69. So here's another spot of $10 extension for AMD. So that's one thing you can do, is you can just look at every historical example over the course of the last year and see what extension it was. It's also a little trickier because, you know, when you're talking about individual stocks, you got earnings reports in there that can influence that, news events that can influence that. So that's just the first thing the first point that I'm trying to get across to you is I'd be a little bit more cautious on daily chart extension thought processes with individual stocks, because every stock is going to be unique compared to the market itself, where we're constantly looking at the market as a layer of probability for all other stocks. So that's the first thing I would say. The second thing I would say is something I say a lot. Counter trend trading is much more difficult than with trend trading. So when you're looking at counter trend trades, I say it a lot. Pat's great at this. He's so patient when it comes to his counter trend trades. I would always rather miss the trade than be too early when it comes to something that's counter trend. You're too early, your counter trend, there's momentum, you're getting your face ripped off. I would rather miss the trade entirely than be too early. Be super, super patient. It's almost like when you're dealing with these big upside momentum moves, it's almost like wherever you think you should get started counter trend, don't. Don't. Wait till it's beyond what you originally thought, and then maybe. I still want a technical entry signal most of the time for it as well. I want that shooting star to come in. I want the actual technical setup to come in. I want to be shorting this stuff in this case, which is different than what I just described for TQQQ, where I'm actually shorting on the way up. When it comes to these individual stocks for counter trend trades, I actually want to be shorting it on the way down or buying it on the way up. So it's already moving in my direction. I have a level that I'm buying versus. I know what my stop loss is. I have a specific reason, and I'm combining the daily chart extension with the market, with the 5-minute chart signal to be able to actually execute. Ideally, I want small time frame extension as well and volume confirmation as well. And then another thing I've been adding in is having Pat tell me what the RSI looks like on the 5-minute as an additional layer of probability. I want every layer of probability if I'm taking a counter trend trade. Because again, I would rather miss the trade entirely than be too early when it comes to counter trend stuff. You really got to be patient there, because you're wrong, especially if you're looking at one of these insane stocks. And like AI is just the one that comes to mind recently because that's been the stock du jour recently. But what was that, HKD? You know, this is a career ender. If you shorted HKD at $200 because it was, oh my God, look at the stock. It just went from $35 to $200. Look how extended it is. It's a career ender. If you're shorting HKD at $200, the way I described how I'm shorting TQQQ, you will probably eventually have a trade that ends your career, to be totally honest with you. You know, like these are insane, these things. You can't just short them because they're going up. The market is different. Apple is different. You know, these things that are very established. The market isn't an individual stock that can go insane like this, though it can become much more extended. It probably could become $22 extended from the ADMA if it ever wanted to. But it's not going to ever do what HKD did. I don't have to worry about that when I'm short SPYs, right? So just be very careful with your individual stocks when you're doing it. That's why I greatly prefer, short it when you get the signal, short it on the way down, not on the way up. That way you know exactly where your stop loss is, and put in the physical stop loss. Put in the physical stop loss. you'll get something that eventually blows past your mental stop loss. You didn't hit out, and then you're stuck like a deer in headlights, and you don't know what to do, and it just gets worse and worse and worse. And if that happens to be an HKD, your career is over. So that's my feedback. I think I covered everything you're asking for. Yeah, again, on the profit side, I would just circle back to what I said to Hemming. You know, cover your risk, cover some at the equilibrium area, and then trail a small amount. When it's counter trend, it's very hard to trail. It's very hard to trail counter trend because by definition, you cannot trail something that's counter trend. At least not based on my rules. You need a full reversal to have happened in order to be able to actually trail. What you're kind of describing, you're just trailing by like $1 or whatever. I actually really don't like that. I don't like when people just raise or lower a stop by a percentage amount or by $1 amount because the market doesn't care about your percentage amount or your dollar amount. I want to trail based on the message that the market is telling me, and I think you know the 3 rules I have for that. So I'm not gonna get back into it. I think because of the news day with the Fed and the yo-yoing going on, I went for it. If it was a normal day, I would have let it go because I would have been early on AMD, and I know it's a beast. Okay. Hemming had a follow-up. Yes, the way it drops is not what I expected, so I'm confused. Well, when it's going in your favor so fast that you don't know what to do, that's a good confusion to have, I think. That's not so bad. From Payne. What do you think about Nike short? Yeah, Nike had that earnings. I'm surprised that they ended up selling that. I guess it was because of some margin compression. 12.36 today. Super relatively weak. The earnings were last night, right? Was it the day before? I think it was last night, right? It's funny, this chart doesn't look like it was trading on earnings today, but I'm pretty sure it was. I hate the time of day. 123.05. Yeah, this is very similar. Someone asked about a very similar chart pattern yesterday. I think it was NVIDIA. No, maybe it wasn't NVIDIA. Someone asked about a very similar chart pattern yesterday, and I really don't like it. It's midday. You've got a bearish consolidation. It's in front of lows, so maybe it breaks down, but the market's not necessarily on your favor, not supporting you. It's still within the range of the day. So I actually don't love the spot or the trade. I think that there is like almost an equal probability of breaking up as there is breaking down, and which could still be fine if your risk reward makes up for it. But I also think that there's a high probability of shakeouts in directions here that are just leading to nothing as the stock consolidates and goes sideways because it's the middle of the day and it's the middle of the Fed day as well. So hope that helps. All right, gang, I'm gonna wrap it up. Really sorry about the snowstorm and the internet issues today. This is probably the worst it's been since I've been out here. And it's funny because my internet was fine all day when I was trading. It's just when I started this afternoon meeting. So apologies about that. But if you're watching on YouTube, because we all had to watch on YouTube, give it a thumbs up anyway. Just because I appreciate it. That's all I ask for my hour of work here. Just give me a little thumbs up. Have a great night, everybody. I will see you all tomorrow.